Hi, good to see you. I think that's fair. Last week was historic in certain segments of the markets, global yield curves, not just Australia, but places like New Zealand and Canada. In terms of how we got to this, listen, I think it's obviously just a function of where we got to in terms of the pandemic and these incredible monetary policies that were put in place. In an Australian context, we had a pretty unique situation where the RBA attempted to, and did, target the price and the quantity of money. So what that means is that they instituted yield curve control, which was the idea that you could target a 3-year bond at 10 basis points and stick with that, whilst also committing to a quantitative expansion of the balance sheet. Not many people have tried to do that. Japan is probably the only precedent. They've been doing that since about 2016, and they've not tried to exit that policy. Whereas what happened last week, Thursday, Friday, was that functionally the RBA did. They were expected to show up maybe on Thursday, but certainly on Friday to defend that yield curve target, and they didn't. And so the expectation in the market now is that it's finished. It'll be formalised tomorrow. But there's so many questions about tomorrow now. The RBA meeting tomorrow was not meant to be very controversial. But from where things are set up now, it's going to be incredibly controversial. There's different scenarios in terms of how it's going to take place, but the RBA certainly has a case to answer after Friday.
We need to find some middle ground, don't we, Grant? Because the market's priced in 5 rate hikes, but no one's ready to believe the RBA saying we're not moving till 2024. What's a ground that keeps everyone happy?
Yeah, so there's probably 3 broad scenarios tomorrow. The least likely is that the RBA tries to rebuild yield curve control. They sort of say, that was just like a mulligan and we didn't mean it, and we're coming back in at 10 basis points. We think that's highly unlikely. They know what they're doing. They signalled that effectively on Friday. People in the market are still talking about that scenario, though, so I'm just sort of flagging it. The middle ground, I think, is that they basically say yield curve control is finished, and yet we are sticking with our guidance in terms of liftoff, which is 2024. It's a long way away. We might tinker with quantitative easing. We might say that tapering is going to come down from 4 billion to 2 billion a month from February. So something like that, where you're starting to move the gears a little bit, and you're trying to balance the hawkish and the dovish aspects of it. The hawkish scenario, I think, and it's hard to say exactly because so much has been priced. Maybe all these scenarios are dovish versus what's priced. But I think the third scenario is that the RBA just comes out and just basically ditches not just yield curve control, but the 2024 guidance. They don't try to replace the 2024 guidance with 2023 guidance. They basically say, from now on, we're going to be data dependent. We've still got downside concerns on wages, on risk of COVID coming back, China, so on and so forth. Those are the 3 broad scenarios. I think it's probably like 5% for the first one. Maybe only 30 or 40% for the second one. The base case is that, the RBA basically moves on and tries to justify what they've done while still, trying to narrate a relatively dovish outlook in terms of liftoff because they need to, and for the reasons we can discuss in terms of my AFR article.
We sure do, and I would like to lead into that because, I remember when macro-prudential tools were untested and they brought them in, and now exit strategies could prove to be painful. And as your article points out, there's a mark-to-market risk, there's a coupon collection, which is good, but then there's the matching of the 10 basis point funding with mark-to-market of market rates. So all of that is a long-winded way of saying, and what you're trying to say is, this will not be a costless exercise. Does it mean that QE can be put in the bin for future crises?
Yeah, it's a great question. Long conversation as well. It's quite technical. That's why I sort of had to write it down, for the newspaper, because I think there's been an assumption in this country, and it probably comes from just, mainstream media and, even the sort of the Paul Keating sort of thesis that this is free money when we do QE. That's fundamentally wrong. It's not free. Even Phil Lowe said, that there's going to always be a price to be paid. There's no free lunch. And until last week, that was sort of a moot point. But last week did change a lot of things. And so the reason we went public on that was just to explain that, yeah, there could actually be a really, really significant bill for QE if things keep going in the way they're going. That's not our central expectation, but we need to at least explain, what can happen. And yeah, listen, basically what can happen is that the RBA has bought effectively $500 billion worth of assets between the term funding facility, long-dated open market operations, and then actual QE. They've funded that at a blended rate of about 0.57%. And so in the years ahead, if the cash rate jacks up beyond that point, then they've got a fixed rate asset on their balance sheet across all of those three different things. But the way they have to fund that is ongoing, and it's effectively daily, which is referred to as the exchange settlement balance rate. And if that gets above 0.57%, then things start to get quite funky, and it will start to deplete their equity. Now, there's various moving parts, as you mentioned. They don't have to bring these things to market every day. It's effectively once a year. But right now, they're sitting on huge losses on their bond portfolio. They're going to accrue income in terms of the coupons of the bonds they bought at a premium, but those bonds will pull to par. And the killer will be if the cash rate actually jacks up to 1 or 2%. Then you're looking at a huge bleed in terms of the RBA's capital, which is only about $15 billion against a balance sheet of $600 billion. And you could be looking at a multi-year scenario where they're heading towards negative equity and have to actually get a recapitalization from Treasury, which means the taxpayer is actually footing the bill. So again, that's long-winded as well. It's quite technical. You can read through what we've written, or you can reach out if you want the more coherent explanation. We're not saying this is going to necessarily blow up or impinge upon monetary policy considerations in the near term, but over the next 1, 2, 3 years, we felt like it's time to start the conversation. Now, QE was never free, and it was never riskless. And it might be that the dark side of QE is going to confront us in the years ahead.
And of course, as you know, the only reason we did QE was because everybody else did. So is this sort of coming back to haunt them as well? What if we didn't do QE? What if the currency was 78 instead of 75? Would we be having a different conversation?
So globally, this could play out if we indeed have these inflation sort of shocks around the world, and it seems to be playing that way. And in some ways, the RBA is in a better position than most because they're just creeping back into their inflation target zone. This same dynamic in terms of depleting central bank capital and having a call on Treasury, it'll probably hit first in New Zealand, frankly. And we've had that conversation around New Zealand multiple times on this program. The Bank of England as well. This is a red hot issue on Threadneedle Street. The ECB is incredibly complicated because you've got a capital key and so on and so forth. The Fed's been there and back, and they've got a relatively fuzzy framework in terms of the FOMC, how it operates in terms of the regional reserves. So I think it's probably more the periphery where this will play out. But it's absolutely I wouldn't say it's a live conversation. It's like an incipient conversation where there's not an acknowledgement that there is this flip side to QE and the taxpayers might be on the hook. It will play out if the inflation thematic that we've been talking about this year, continues. If it is indeed transitory, this will go away. There's no problem. Central banks can, do their job, even running their equity down or even into negative equity if it is indeed transitory. But if we get cash rates up to 2, 3, 4%, no, this is going to change everything. The fiscal cost of that will be explosive, including in this country where, the current government or the new government from the election, imagine them, being tapped on the shoulder and asking for, 1 to 2% of GDP to repair the RBA's balance sheet because they did QE. Bearing in mind that most of that funding is going to be to subsidise the banks. That's going to be a pretty awkward conversation. So it's too early to sort of go there in terms of drawing conclusions, but it certainly wasn't too early to open the conversation because the conversation really hasn't even started yet.
Do you think at the end of the day, yield curve control served a purpose, the term funding served a purpose, QE, give or take, I personally think it's questionable. The bottom line is if we're fully vaxxed, we're reopening, people are employed, start paying taxes, we may end up with a virtuous circle such that these mark-to-market losses don't necessarily have to be an issue to worry about.
Yeah, that's potentially fair. I think it's just the order of magnitude, which concerns us. Central banks might also find, new accounting methods to sort of dodge the bullet and to, kick the can down the road so that these losses are not fiscalized. There's definitely ways to use creative accounting because the way that they account for these sorts of issues effectively is self-determined. But at the same time, like the RBA particularly, I mean, they're under pressure to have an independent review of what they've been doing for the past 5 years. If they start racking up, billions of dollars of losses, I don't think that they can necessarily withstand that sort of scrutiny. And the request to Canberra for like these sorts of numbers, if it comes to that, I think that's not going to go down well. Now, can they justify that? Yeah, listen, absolutely. I mean, I think that, the initial foray into QE was timely, it was important. We could have had a complete meltdown in the banking system, the financial system. There's no questions about that. They can definitely justify their actions. But it's still a tricky conversation. This is about loss allocation at the end of the day. And I don't think it was necessarily broadcast at the time that these sorts of things could actually have a fiscal cost. Like, I think that's the issue. There was support across the entire bureaucratic and technocratic sector in Australia and beyond, to wade into the markets in the way that both the RBA did and the government did. And yes, absolutely, that's underwrote the recovery that we've seen and puts us in a position, pending COVID doesn't come back in scale, to rebuild from this. But at the same time, there was no talk, when these things were being rolled out, that it actually might cost the taxpayer. It was being narrated as free money. It's not free money. That's the point. If cash rates get jacked up to 1%, 2%, 3% in the next couple of years, there's going to be a price to pay for sure. So that was the point we were making, and it's a timely point. I think it's not well understood, and we just wanted to make sure that there was an acknowledgement that these things are, they're not free.
Article away, because I'm sure we'll be talking about it again maybe February next year when they have their next look at policy. Thank you. As always, thought-provoking there, Grant.